This is a weekly breaking Forex news update from Horse Forex. For more information, visit our website at www.horsegroup.top. Euro, Eurozone, economy, recession, coronavirus. Talking points. The euro may be at risk of aggressive liquidation pressure as the politically sensitive currency is tormented by familiar internal geopolitical rifts between the North and South, while interregional tensions are nothing new. The circumstances in which they are resurfacing could have more of an impact on the euro now than before. The Eurozone now stands on the edge of a recession, far worse than what it had endured over a decade ago. After debating for over 16 hours, Eurozone finance ministers were able to reach a shallow agreement. Some of the provisions agreed upon included borrowing with almost no strings attached from the bailout fund known as the Emergency Stability Mechanism. Italian officials rejected the offer after recalling what had happened to their Mediterranean neighbors during the Eurozone debt crisis. The fear of losing domestic sovereignty to external institutions is a bitter fruit for Mediterranean states to swallow and constitutes a part of the wedge driven between northern and southern Eurozone members. This sentiment is particularly acute in Italy, where the right-wing leader Matteo Salvini of Lega Nord has decried the proposal. EUR-USD may once again start trading under the steep guidance of descending resistance labeled as downtrend alpha. This came after the pair failed to clear the lower tier of an inflection range between 1.0981 and 1.0989 that subsequently led to 1.30% decline. The next level to monitor will be support at 1.0783 if it breaks below it with follow-through. EUR-USD may face severe liquidation pressure. Crude oil prices rise on the hopes U.S. to emerge from COVID lockdowns. Crude oil prices rose in Asia Friday on hopes that at least portions of the U.S. economy can emerge from their coronavirus-inspired lockdown earlier than had been feared. U.S. President Donald Trump on Thursday issued guidelines on a phased restart. But of course, precise timing is impossible to pin down and will depend on the success with which the contagion can be halted. There was a broad revival in risk appetite in Asian hours. U.S. stock futures surged in response to reports that pharmaceutical company Gilead, which has been testing one of its drugs as a potential coronavirus treatment, has had some early success in trials. This was more than enough to offset any gloom endangered by China's official gross domestic product numbers. These duly delivered the first contraction seen since 2012, and deeper output fails that had been forecast. However, they were released as a part of a mixed bag of data which saw March industrial production under much less duress than markets had feared, even as retail sales collapsed. Still, crude oil markets still look headed for a second straight week of fails, despite recent production cuts. Demand destruction as a result of the contagion continues to glower over the energy space. The Organization of Petroleum Exporting Countries, OPEC, has lowered its forecast for 2020 global oil demand and warned that more revisions may come. It now sees a demand contraction of 6.9 million barrels per day, having predicted a modest increase before. Gold prices fell on the broad risk appetite revival, although, as usual, there seemed little prospect of a meaningful dent in the strong haven bid the metals enjoy. The coronavirus has reportedly seen gold consumption hit a 3-decade low in India as the lockdown has kept stores closed through festivals and the crucial wedding season. The rest of the global session won't offer markets any likely shattering data points, but officials' Eurozone inflation figures may remind gold investors that while there seems little need for the metal as a hedge against rising prices, bonds yields won't be rising soon either. That prospect often lends support to non-yielding gold. Yuan, SGD, IDR, MYR, PHP, China, ASEAN, FX price trends since 2008. This is a special report that discusses how Yuan ASEAN FX dynamics played out during and after the 2008 financial crisis. The latter currencies include the Singapore dollar SGD, Indonesian rupiah IDR, Malaysian ringgit MYR, and Philippine peso PHP. These are tied to nations that are key trading relationships with the world's second largest economy, China. How might that impact their trends with sentiment? Over a decade ago, during the heat of the global financial crisis, there was an aggressive shift in capital flows with an orientation away from pursuing return and into minimizing risk. The MSCI Emerging Markets Index, EEM, fell over 62% from its peak in May 2008 to its trough 5 months later in October. In the years that followed, this inverse relationship between my ASEAN-based Yuan index and with general market sentiment seemed to continue. From the middle of 2011 until the early stages of 2016, the EEM slowly traded lower with episodes of sideways price action. At the same time, we saw a steady appreciation in the yuan against its ASEAN counterparts. However, the relationship between the yuan's value against ASEAN FX began to slowly show a positive correlation after Donald Trump was elected president in 2016. One of his areas of interest was the large trade deficit the United States had, and still does, with China. Since the campaign trail, his goal has been to reduce it. As a policy route, he chose protectionism and started a trade war. China's still heavy reliance on trade made it relatively more vulnerable to an escalation in cross-Pacific trade tensions. Since the trade war was pointedly aimed at China, it is not surprising that the yuan started to take on a more pro-risk role when comparing it to the MSCI Emerging Markets Index. Throughout 2018 and most of 2019, when the EEM weakened, my ASEAN-based yuan index aimed lower. With that in mind, if tensions between the world's largest economies heat up again, the CNY may again face formidable selling pressure. The past inverse relationships between its price action and market buoyancy could be restored if China and the U.S. settle their differences. Australian dollar struggles as China GDP falls more than expected. The Australian dollar backtracked a little Friday on news that China's economy shrank in the first quarter of this year, and by more than the markets had expected as coronavirus exacted its toll. Official gross domestic product was down by 6.8% on the year, worse than the 6.5% expected and the 6% rate seen at the end of 2019. March industrial production was released at the same time. It slipped by a relatively modest 1.1%, much better than the 7.3% feared and hugely better than February's 13.5% collapse. Retail sales plunged, however, falling by 15.8% last month when a slide of only 10% had been expected. Obviously, overall contraction was expected, and it remains arguable that perhaps China's economy is doing better than many in attempting to restart itself from the virus-induced torpor. Initial 2020 growth forecasts will, of course, now need to be shredded. But China is hardly alone in that. The Australian dollar often acts as the foreign exchange market's favorite liquid proxy bet on the Chinese economy. This is largely thanks to Australia's vast raw material export links to China. It seems to have played that role on Friday, wilting in the wake of the data. Still, the currency has bounced back remarkably from the lows to which it and other growth-correlated assets were pummeled in March by the realization of coronavirus likely impact. That strength has been rooted in the strong, coordinated fiscal and monetary response to the crisis by countries feeding hopes that a surge of liquidity will turbocharge the recovery when it comes. The Reserve Bank of Australia's disinclination to push domestic interest rates to zero for the first time this month has probably helped too. However, none of this good news alters the reality that most major economies remain in some sort of a lockdown and that stimulus can't really work while there's so little economic activity to stimulate. The Australian dollar and other assets with similar risk profiles must remain vulnerable to any perception that economic shuttering will be a lengthier process than markets at first thought.